Thank you, Natalie. In the next 30 minutes, I want to give you a new lens on the question that's been asked today, an understanding of why the choke points in the global economy that worry investors the most may not be the ones that matter the most for long-term returns. This year's showcase theme, scarcity, standoffs, and fragmenting trade flows, point towards physical geography. I'm going to argue that that's the wrong place to look. To briefly introduce myself, I'm Chris Elliott, CIO at Evenlode Investment and a fund manager on the Curate Global Quality Equity Fund. Now, when investors talk about scarcity and standoffs in 2026, they tend to point to the same handful of places on the world map. The Strait of Hormuz, at the center of a live Middle Eastern conflict, where a quarter of the world's seaborne oil still has to physically pass. The Taiwan Straits, where a single company makes the chips the rest of the technology industry depend on, or container ships being rerouted due to droughts closing the Panama Canal or increased risk of privacy across many major waterways. These are real constraints. They do matter. And capital allocators are right to think about them because markets do respond. Energy spikes when the Gulf gets tense, or shipping rates jump when trade routes close. But these market responses tend to fade faster than the headlines would suggest. However, there are other types of checkpoints, and for long-term investors, we would argue that these are the ones that matters most. These are the more durable ones, the ones that quietly shape returns over the spans of decades, not simply weeks. They're economic, not geographic, and they sit inside the way a business operates, not on a map where things move. We call these economic choke points toll roads. And to be clear straight away, we don't mean the type with tarmac and a barrier. We mean businesses where the customer doesn't really have a choice about whether to keep paying, not because of a contract that locks them in, but because unplugging the relationship would be more disruptive than it's worth. The toll isn't large, but the road is hard to leave, and every year more traffic flows down it. Now, that description probably sounds close to something you've heard before, words like economic modes or competitive advantage or pricing power. And there is an overlap. But the toll road image captures something that those other words miss. A moat suggests a defensive fortification, where a toll road means a small recurring fee paid voluntarily year after year because the alternative is worse. And that distinction matters. So what do these toll roads look like in practice? Let's consider a few examples. The first archetype is a business that customers can't unplug. This could be the software that a finance team uses every day, or an ingredient that is specified into a product's formula and has been tested and approved by regulators. The cost of leaving isn't the cost of the service or product itself. It's in retraining users or in the cost of new inspections and approvals. And importantly, the cost to switch is higher than the gain to the customer from switching. The second archetype is the business that customers can't replace. And this is subtly different. The switching cost itself might be fairly low, and any customer could, in theory, go elsewhere. But the question is where? When a business's value comes from the breadth of participants, transactions, or the data flowing through it, there is a natural consolidation of supply to either a single company or a very small group of companies. For instance, a marketplace where every serious participant in an industry is already trading, or a contributory data utility that everyone in a profession quotes from, but more importantly, contributes to, are very, very stable businesses. Going elsewhere doesn't just entail the costs of switching. It means that relying on a smaller, thinner version of the same product or service yourself, and that has a real cost to the end user. The third archetype is a business with a range of products the retailer or distributor can't afford to omit. The branded consumable that earns its shelf space every year, because if the supermarket doesn't stock it, the customer will switch stores rather than switch brands. The toll here isn't paid by the end consumer. Instead, it's paid by the retailer, who accepts less favorable margin terms because the alternative is losing the customer entirely. 3 mechanisms: can't unplug, can't replace, can't omit. Each one a different reason a customer keeps paying, but the same underlying shape. Now, it's important to understand that not everything that looks like a toll road is actually one. A physical choke point often feels like a toll road, but the test is whether that choke point is durable or just temporary. Ships can be rerouted, pipelines can be redirected, and new refineries can be built in different countries. That is why many physical choke points are often only temporary in nature. And a choke point that holds only as long as the alternatives are more expensive is a cyclical advantage, not a durable one. And to be clear, this is not a physical versus virtual debate. Not all software can be a toll road either. A productivity tool with 3 good substitutes is a feature on a roadmap, not a choke point. The test is whether a customer's workflow depends on it, not whether the product is good. Good products can be replaced and technical innovations copied. Embedded workflows can't be. So, as you can now see, the definition of toll roads is much narrower than it looks, which is why when we apply it strictly across a global universe, we end up owning only between 30 and 40 businesses. What's more, we have observed that these types of businesses often do better when the world gets more complex, in times of scarcity and standoffs. And there are 3 reasons for this. The first is that complexity is a tailwind for incumbents. When the world gets complicated, decision makers retreat to what they already trust. They don't shop around. A finance director that's already worrying about tariffs and currency and a board that wants weekly updates is not going to spend the year evaluating a new accounting platform. Importantly, this demand is asymmetric. Trusted suppliers gain share faster in hard times than they lose it in easy ones. Once relationships deepen for a difficult period, they tend to stick. So when a customer comes to review the vendors, the incumbent has another year of evidence demonstrating that they provide an indispensable service. Disruption ratchets the relationship, but calm doesn't reverse it. The second reason is pricing power, and I want to be very precise about what this phrase actually means, because it's one of the most overused terms in our industry. Pricing power isn't just the ability to put prices up, it's the ability to put prices up without losing the customer. Anyone can raise a price. The question is what happens next. If a commodity producer raises prices and peers don't, they will lose volume. A business with no real substitute raises prices and the customer pays. The difference isn't the size of the increase, it's about the customer's response. And the third reason is about capital intensity. And this is the one I find most interesting because it's often the least talked about. The world we're investing into now is one where capital has become genuinely expensive again, after 15 years of being almost free. Interest rates are higher and likely to stay higher against the 2008 average, and the demand for capital has skyrocketed. The energy transition demands capex. AI infrastructure demands capex. Reshoring demands capex. European defense rebuilding demands capex. Almost every macro narrative you read ends the same way. Somebody is going to have to spend a lot of money on physical assets. Now, in this capital-heavy environment, businesses that don't have to spend are quietly advantaged. They don't have to choose between investing in growth and returning cash to shareholders. They generate cash, reinvest a very small fraction, and can return the rest. And critically, the cash that they return is worth more in present value terms than it was when rates were near zero, while the capital-heavy businesses must compete for funds and are seeing their cost of capital rise. So, complexity drives customers towards the suppliers they already trust. These suppliers have structural pricing power, meaning they can increase prices without losing volumes. And this generates a stream of steadily growing cash flows that they can use to fund reinvestment, and is even more valuable when capital is expensive. 3 reasons stacked one on top of the other. So how do we take advantage of these long-term dynamics? The way we run this fund is straightforward. We're trying to find and own a concentrated portfolio of businesses that genuinely have these toll road economics. The discipline is in finding them at an attractive entry price and in saying no to everything that doesn't fit. So what's on our checklist? We want recurring revenue, meaning the business sells something its customers buy again and again, year after year, without having to be re-persuaded each time. Pricing power, which is the ability to put prices up and retain the customer, importantly. And we want low capital intensity, meaning the business doesn't have to keep plowing money back into factories, fleets, or networks just to stand still. And very importantly, we want a position that the customer really doesn't have an alternative to. It seems a very simple checklist, but the reality is that the vast majority of companies don't pass it. So let's have a look at a few examples that do. The first is RELX, one of the largest positions in the fund. RELX runs 4 businesses: scientific publishing through Elsevier, legal information through LexisNexis, risk and data analytics, and exhibitions. The first 3, which together generate the vast majority of profits, are essentially the same business model. Indispensable datasets of professional information that customers pay for every year, and where the value of that dataset goes up as more records are added. This is the can't unplug archetype made concrete. Take LexisNexis, the legal research dataset. A law firm builds its entire research workflow around it. Every lawyer in the firm is trained on it. Every case file references prior research conducted through it. So the cost of switching isn't the subscription. It's in retraining every lawyer in the firm and accepting that something will go wrong with a citation that no one can predict in advance. So the firm doesn't switch. And every year, LexisNexis adds more cases and more analytical tools, which deepen the integration further. The toll road gets harder to leave the longer you've been on it. Now, in the current market, AI is the obvious challenge to a business like this, and we should address it here. What we've seen so far is that businesses inside RELX are using AI themselves to deepen their offerings rather than being disintermediated by it. The proprietary content, the trusted citations, the workflow integration, these are the things that AI tools need to draw on to build more value, and that they can't necessarily replace. We'll continue to watch it very carefully, but the early signs and the organic growth acceleration provide evidence that the toll road proposition is being reinforced by AI, not threatened by it. The second example sits right in the middle of the physical choke points we opened with. Clarkson is a 170-year-old shipping broker based in the UK. When a tanker wants to charter a vessel or a commodity trader needs to move a cargo of iron ore, Clarkson sits in the middle, matching the parties, taking a small commission, and gathering market data with every transaction. This is the can't replace archetype. The barrier here isn't the switching costs. Any client could, in theory, go and work with a different broker tomorrow. Instead, the barrier is that no other competitor sees as much of the global shipping market as Clarkson does. The more deals they see, the better their pricing intelligence becomes. The better the intelligence, the more clients want them in the room helping with deals. And the more deals they are party to, the better their ability to gather that pricing data. This is a self-reinforcing position, or a virtuous cycle, that makes the network almost impossible to replicate from scratch. You couldn't build it in a decade. Now, this is a much smaller position for the fund than RELX, not because our conviction is lower, but because Clarkson is a smaller company with limited share liquidity, which caps how much we could responsibly own. If it were a bigger company, we'd own lots more of it. is exactly the type of business this philosophy is built around. The third holding that I want to discuss is L'Oreal, our largest consumer holding at around 5% of the fund. L'Oreal owns the broadest portfolio of beauty and personal brands in the world, across mass market, premium, professional, and luxury. Brands that you'll instantly recognize like L'Oréal Paris, Maybelline, Lancôme or Kiehl's, and many, many more. This is the can't omit archetype. The toll here isn't paid by the consumer, it's paid by the retailer. A supermarket, a department store, a pharmacy chain cannot afford not to stock the major L'Oreal brands. Because if they don't, consumers who came in for that specific shampoo or that specific moisturizer will go to the retailer that does. And this dynamic is global. It works the same way in a French hypermarket, an American drugstore, or a South African pharmacy chain. And what that produces is a steady stream of recurring revenue. People buy their product month after month, year after year, often keeping to the same brand for decades. This comes with low capital intensity, as L'Oreal doesn't need to build lots of factories or stores, so it can continue to reinvest capital and to build those brands. This is the toll road idea applied to something as mundane as a tube of lipstick. Now, these three holdings are illustrations, obviously not the whole portfolio, but you'll see the same logic at work across all of the other names that we own. In the payment networks, in financial market exchanges, in the global insurance brokers, or the branded consumer goods companies, or even a lot of the information and data utilities. For every name in the fund, there is a small toll that the customer pays for traveling on a road that they can't easily leave, and they pay it again and again and again. Now, just as importantly as discussing what we do own, let me briefly talk about what we don't. We don't own highly cyclical businesses where fortunes depend on the macro cycle, on commodity prices or capital spending swings. Now, as we've seen recently, these can be wonderful investments at the right point in the cycle, but they're not toll roads. The durability of their pricing power is often most at risk exactly when scarcity arrives, because customers are forced to either cut back or find alternatives, which leads to future competition. We also don't own capital-heavy businesses, where companies have to keep spending enormous sums on physical assets just to maintain that position. Because we believe in a high-rate world, businesses competing for scarce capital are at a structural disadvantage relative to those who don't. And we don't own businesses that rely on a specific regulatory or political outcome to succeed. These are often very hard to predict and can change very quickly. Subsidies can be withdrawn, tariffs imposed and overturned, and regimes themselves can change. Now, these types of companies particularly can look attractive in an individual year, but fundamentally, their toll roads are built on somebody else's land. Now, all three of these groups of companies can be excellent investments. They're just not investments for this fund. So that's the philosophy and the portfolio. But the obvious question to ask is whether it actually works, whether the businesses that we invest in really do behave the way our philosophy claims they should. Well, the good news from our point of view is that the real world has been turning up with some frequency over the past few years to test our thesis. Since 2001 alone, we've experienced one of the fastest rate cycles in 40 years, supply chains genuinely broken for the first time in a generation, war in Europe, a regional banking scare, major AI capex boom, tariff regulations, and now an ongoing Middle Eastern conflict. So a good test set to see how the company's performed. Well, what we have observed and what the bar chart here is showing is that the businesses we own kept growing steadily, quarter after quarter across the period. Not dramatically, not unevenly, and the bars show mid to high single-digit organic revenue growth in every quarter over the past few years. The line on the chart, you can see, is the price of the MSCI World Index, which has gone up, but been highly volatile, demonstrating the level of macro uncertainty that we've seen. So how did these companies achieve that? Well, what was going on underneath relates back to the three reasons we discussed previously. Complexity was driving customers towards the suppliers they already trusted. And across the portfolio, we've seen deeper customer relationships, higher renewal rates, and new business wins coming from competitors that have lost share rather than from the markets expanding. Our second observation is that pricing has held. When input costs spiked a few years ago, the businesses in the portfolio were able to put prices up modestly but repeatedly, and customers paid. Volumes have held, and margins for these companies even increased. Many businesses in the broader market tried the same thing and found their customers simply walked away. And the third thing we observed about this group of companies is that throughout this period, where large parts of the market were committing vast sums of capital, these businesses were able to continue to self-fund their own investments. They generated significant amounts of cash flow, invested sufficiently, and returned a growing and tidy sum to investors. It's worth saying briefly that this isn't a story about the past. The most recent set of results from the first quarter of 2026 looks in aggregate much like the ones that came before. In fact, with an ever so slightly higher organic growth rate. Now, I'm not going to pretend to know what happens next. Nobody does. But the texture of the world ahead, capital expensive, supply chains contested, geopolitics fractious and complexity rising, looks to me much more like the past 4 years than the relatively easy decade before. And if that's right, the businesses that quietly compounded through the recent stress should be well positioned to continue to do so. Not because we're calling any particular outcome, but because of the structural dynamics that protect them. Now, I'd like to spend the last few minutes on the question of what role a portfolio like this might play in the way you are building things for your own clients. Most of the wealth managers we've talked to in South Africa are running portfolios that already have meaningful exposure to local equities, local fixed income, and local currency. The global allocation, the offshore portion, is doing real work, not just geographic diversification, something structurally different. The first thing a strategy like this can do is diversify, and not just by geography. A portfolio of global toll roads isn't just exposure to different countries. It's exposure to a fundamentally different type of business to those that dominate the South African domestic market. The second role is that the strategy is resilient to the kind of global shocks that matter most and that we have seen occurring with increasing frequency, such as currency volatility or geopolitical shocks that compress trade. This portfolio isn't insurance against a particular outcome, but a hedge against the increasing complexity of world markets. The third role of the portfolio is as a steady source of compounding over time, one that doesn't depend on a specific trend remaining friendly. Most equity strategies are implicitly betting on something, be it falling rates, multiple expansion, sector rotation, or a very particular theme. A portfolio of toll roads is compounding from the businesses themselves. And for a client portfolio that needs to work over a period of a decade or two of unknowable conditions, we believe that's a genuinely useful property. It's also important to be clear about what this strategy isn't designed to do. This isn't a strategy designed to outperform in every kind of market. In years where speculative or deeply cyclical assets are running, a portfolio of compounders will often look quiet, even dare I say boring, by comparison. But as a former software engineer, I would say that is a feature, not a bug. It reflects the fact that businesses aren't chasing cyclical drivers. This also isn't a tactical allocation. It compounds visibly over years, not months. So if you're looking for something to rotate in and out of as macro conditions change, this isn't really the right tool. And it's also not the whole answer. A diversified portfolio probably wants to include exposure to other things alongside it, emerging markets, fixed income, perhaps more cyclical equities. And I'm sure the Curate team will be more than happy to point you to the right complements. Now, this strategy is designed to be a compounding core, something a client can hold for a decade and largely leave alone, while the businesses inside it do their quiet work. And that brings us to the end. So thank you very much to Curate and to Natalie for hosting, and to you for listening. So let me close with what I think is the single most important thing to take away from this presentation. The conventional reading of choke points, the physical ones, the straits, the pipelines, the container routes, isn't wrong, but it's incomplete. The choke points that matter most, that compound returns over a decade and more, sit somewhere else entirely. The toll roads worth owning aren't on the map. They're in the invoice no one questions, the software no one replaces, and the brand that earns its shelf space every year. This is what the fund is built to own. And these businesses earn their right to charge these tolls most in a world of increasing scarcity and standoffs.